Hi, I'm Jimmy. In this video, we're going to walk through a quick review of where the US economy stands. We're using various economic indicators to see if we can objectively gauge where the economy stands, and in theory, this could lead us to making a better investment decision. Should we invest now or wait for the stock market to crash, which we all know will eventually happen? Okay, let's jump right in. So the United States is entering a very interesting time period from an economic standpoint. So I'm sure we all have an idea of how the economic cycle works, but just so we're all on the same page, let's just look quickly at it so we can better understand where we are today, and ultimately, does it make sense to invest our money today, or should we wait for the stock market to crash? So this is a typical chart of the economic cycle that I'm sure we've all seen. This is the classic textbook economic cycle chart. So we have a bottom. Sometimes they call this the trough. Last time we were in one of these, this was in the 2009-2010 area at the bottom of the Great Recession. Then after the bottom, well, clearly we enter the expansion phase. And for us, this began around 2009-2010. We've been in the expansion phase, and the stock market and the economy have been climbing ever since. So obviously, our question is now, are we at the peak, or are we here approaching the peak, or perhaps we're somewhere after that? Perhaps it's already on the downturn, just all the things haven't lined up quite yet. Well, I bring this out because I've been trying to profile what the peak looks like from an economic standpoint. And it's tricky since there's no clear-cut answer to exactly how a peak should look. But typically, there are a few common things that happen at the peak. Generally, we get higher inflation, we get higher interest rates, and often there's pressure on the consumer, often in the form of wages. Consumer confidence begins to fall, and generally speaking, the consumer begins to spend less. As that happens, as the consumer spend less, we enter further into the economic contraction, and before we know it, things collapse and we hit the bottom. So let's look quickly at each of these. So the first one we can look at is inflation. Now, inflation isn't much of a leading economic indicator, but as we can see, back towards the Great Recession area, well, there was a relatively large jump in inflation relative to where it was before that. And if we're curious, the stock market peaked right about there. So I think this is important because oftentimes, in hindsight, inflation tends to be higher relative to its more recent past when you're near the peak of the economic cycle. So switching back to the economic cycle chart real quick, well, a moment ago we asked, are we here, here, or here? Well, I think that it's unlikely that we're here at this point because it seems that we would have seen a spike in inflation, or at least a bigger spike in inflation than we have. And when we switch back to the inflation chart, well, here, we're not really seeing that spike that I would have expected near the peak. Right now, the most recent inflation number came in about 1.7% when compared to last year. And basically, all this means is that things we buy on average would be 1.7% higher. A basket of goods would be 1.7% more expensive this year than it was last year. And this leads nicely into our second economic indicator, and that's interest rates. So we may have heard the news that the Federal Reserve is lowering interest rates again. And this is a chart of the Fed funds rate. And this drop right here, well, this is the result of the Federal Reserve lowering interest rates in the most recent time period. We can also see that they've done it a few other times this year. Now, typically, when interest rates fall, inflation should move higher. And if we think about it, this is fairly logical. If there's lower interest rates, well, this means that more people and more companies can borrow money cheaper. If money is cheaper and in theory easier to get, well, it should lead to more people buying things. And another way to put that is that if there's more people buying things, there's a larger demand. More demand should lead to an increase in prices. So that's the reason ultimately that lower interest rates should result in higher inflation levels. So this brings us to our economic scorecard. Now, I think it makes sense to put inflation as a neutral point. So both the bulls and the bears get a point on the inflation side. But now where do we put interest rates? On one hand, lower interest rates should help push the economy forward. It should help move things. So that would be a point for the bulls. But the fact that they're lowering interest rates implies that the Fed is trying to move the economy higher. And as of, I think it was July of 2019, well, the US is officially in the longest economic bull run since, I believe, like the 1850s. So, does the rally really need to continue at this point? So for me, I actually find this one to be tricky from a scorecard perspective. I think it makes a lot of sense to put this one in the neutral zone. So we get another point for the Bulls and for the Bears. Now, I think this makes most sense because the fact that there's lower interest rates, to me, implies the fact that there's a need for lower interest rates implies that the economy is weak enough to need to kick it forward. But the fact that they have lower interest rates, well, that should help the economy. So once again, a point for both the Bulls and the Bears. Do you agree with me? Let me know in the comments below if you think that we should make this more of a neutral point, or should it be a point straight up for the Bulls or straight up for the Bears? Please let me know what you think. I'm curious. Okay, so let's see what else we have. The next important economic indicator is consumer confidence. This is a chart of consumer confidence going back the past 10 years. And personally, I thought that consumer confidence was going to start to head lower when the chart looked like this in the last video that we did. But as we can see, since then, it's begun to turn higher and it has stuck up near the highs for consumer confidence in general. So where I've been cautious on consumer confidence in recent months because I've thought that there was a chance it was going to break lower fairly soon, well, at this point, it's still up near the high levels. So as long as it's up here, I actually think it makes a lot of sense to give consumer confidence a point for the Bulls, since it looks like it's actually keeping the market, is keeping the economy moving. And until it breaks lower, when we switch back to our scorecard here, well, I think it makes sense to give the Bulls this point. So I think that's the safest way to go until it starts to show true signs of breaking lower. Okay, now on to manufacturing. Now, this is a chart of the ISM manufacturing indicator, and this one is seasonally adjusted. So the key thing for us to watch here is the 50 level. Anything above 50 implies that manufacturing is growing. Anything below 50 implies that manufacturing is shrinking. The manufacturing sector is shrinking. And as we could see, manufacturing has dropped below 50. And this tells us that overall, the manufacturing sector is shrinking right now, which is clearly a bad sign for the economy. Now, I think that manufacturing is one of the biggest concerns for the US economy or even the global economy. This is true around the globe. I think this is one of the biggest concerns right now for the economy. So clearly, this is a point for the Bears. Now, perhaps this is only a temporary pullback, a lot like we saw back in the 2015 area. And I think we should be able to tell whether or not that's true in the coming months over the, let's say, next 3 or 4 months. But for now, to me, it seems like this is a bad sign for the economy. So that needs to be a point for the Bears. Okay, now this brings us to the yield curve. So here are the very basics of the yield curve, just so we're all on the same page. A yield curve looks at the interest rate paid for different time periods. So what interest do we get paid? What interest rate do we get paid if we buy a 1-month treasury versus a 3-month treasury, or a 2-year or 10-year or 30-year? And clearly, the longer that we invest our money for, the more money, the higher the interest rate we should get paid. Now, last month, when we did the last video in this series, well, this is what the yield curve looked like. And the problem here is that the 3-month bond was higher than the 10-year bond. So they call this an inverted yield curve. And a month or two before this, the 2-year was actually higher than the 10-year, which is even worse. Now, here's the most important part about having an inverted yield curve, and that is that every recession in the United States has been preceded by an inversion of the yield curve. But not all inverted yield curves have led to recessions. So, where this is a bad sign for the economy and often leads to a recession, it doesn't have to lead to a recession. Now, if we jumped to today's Treasury yield curve, well, we can see that the yield curve looks drastically different today than it did just a month ago. The yield curve is no longer inverted. In fact, this is very close to the ideal yield curve. It slants exactly as we would expect it to. Now, this is likely one of the main reasons, or one of the biggest reasons, that the Federal Reserve has been lowering interest rates. When they lower rates, well, that bangs down the short end of the yield curve. So, when the yield curve inverted, Clearly, the Fed didn't want a recession to happen, and that was a big indicator that a recession could come up in the next, let's say, 12 to 24 months. It's no longer inverted, so perhaps the Fed stepping in to lower interest rates and even the money that they've been dumping into the repo market is working. So on our scorecard, I think it makes sense to keep this as a neutral point for now, although I do want to point out that the yield curve doesn't have to remain inverted all the way up until a recession. It gets inverted, and then, say, 12 months later, a recession happens. So this is not saying that a recession won't happen. I'm just saying the fact that it's so straightened out and that the Fed is so far, seems to be fairly far ahead of this, could be a positive sign. So now, to answer the question, should we invest now or wait for the stock market to crash? Well, for me, I'm actually quite surprised that this scorecard, just looking at these indicators, I'm surprised that it has landed as neutral as it has. This is significantly, in my opinion, more positive than we saw even last month. To me, it feels like the stock market should crash very soon, just because it's been so long since we last had a big crash. But on the other hand, we seem to be missing some of the key points that typically accompany the peak of an economic cycle. Things like rising inflation and weakening consumer confidence. Now, personally, I've been expecting a stock market crash for about 2 or 3 years now. And from about 3 years ago, well, the S&P 500 is up a bit more than 51% total return. So I'm glad that I haven't felt that the fear of a stock market crash would keep us out of the stock market, because ultimately we would have missed that 51%. So for me, I think it makes sense to keep this same streak going. Although I think it's smart for us to be defensive with our portfolio, perhaps take a hardcore value approach to the portfolio, and to be patient and look for the right opportunities. Don't just rush in. I do think it makes sense to invest now versus waiting for the stock market to crash before we invest, because even though at some point the stock market is going to crash, what if it's another 51% higher before it does? Now, if you want to invest, but you feel a bit nervous about what could happen, I recently did a video on 3 investing rules that could help us control our fear of losing money in the stock market. So if you're looking for another investing video to watch, that's a great one to jump over to. And there's a link in the description below, and you got a link right here. So thank you so much for sticking with me all the way to the end of the video. I really appreciate it. I hope you found this interesting. Let me know what you think in the comments below. And if you haven't done so yet, hit the subscribe button, hit the thumbs up. Thank you, and I'll see you in the next video.